Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. So today will be the special week, or how can I say that Christmas week. So today will be Monday, the 23rd of December, 2024. Welcome to today's Daily Dose of Market Insights. I'm Kelvin here. 2 more days before Christmas and 8 more days before 2024 ends. So what a year it has been. So before we start today's Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so just to make sure that everything is good on the sound check and the screen, so I believe that all is good. All right, so as usual, let's kickstart with what has taken shape on last Friday before we jump straight into today's intraday technical outlook on our usual coverage of those daily broad-based cross asset classes ranging from the FX market, the major stock indices, as well as the two key commodities, which is gold XAU/USD, and as well as the West Texas crude oil. So on last Friday, we do have one important US related data, which is the release of this core PCE index. So core PCE index is the much more preference inflation gauge that the US Federal Reserve officials use to gauge the inflationary trend in US other than the typical CPI data. So for core PCE price index, where this is the focus of majority of the US Federal Reserve under their dashboards, is stripping off energy and food prices, came in below market expectation. So market is expecting at 2.9% year on year. It came in at 2.8% in November, in line with the prior month of October. So if you look at the trend of the core PCE price index, yes, on an absolute basis, it came in below market expectation, but on the trend basis over here, let me flash my screen. Give me a couple of seconds to actually load. Okay, the next tab. Okay, so if you look at the 5-year trend, it seems to be starts to form a base, a basing kind of what I call it, a typical base over here, where potentially inflationary pressure may start to creep back into the US. All right, but despite the fact that we know that market do not sometimes they actually react over optimistically or pessimistically based on a data point, and also taking into account of technical factors as well. So what we could see over here is that yes, last Friday, better than expected core PCE price index, which came in slightly below expectation, 2.9%, below 2.8%. That's deemed as good for risk asset because they reacted accordingly, indicating having a very short-term near view that the Fed may not be so aggressive, or put it away that the Fed may not be so less dovish in 2025. Then that actually led the major US stock indices to rally. All right, so all the 4 major stock indices actually rallied. The SPX up 1.09%, the Nasdaq up 0.85%, the Dow Jones up 1.18%, and the Russell 2000 up 0.94%. So this rally actually came due to that oversold condition, the exposed FOMC sell off. All right, and that also saw the dollar strength setback as well. So if you look at the dollar against the other major currency, it starts to shape that setback over here. So this was the rally exposed FOMC, where you could see on the screen here the dollar against other major currency. Then thereafter it do that setback. All right, during the on last Friday, upon the release of the better than expected core PCE price index. So this is very short term in nature because of the technical factors and as well as the news flow that impacted it. But if you look at from a medium term perspective, has the Dow changed? In fact, no. Why? Because if you look at the CME Fed Watch 2, based on the futures pricing, The next FOMC meeting, which is on the 29th of January next year, market is still assigning a no change at 89.3%, a rather high chance. All right. Yes, prior to the release of the core PCE price index, it was at 91%. So after the release of the core PCE price index, yes, it's better than expected, but that's only an absolute basis. But the Fed Funds futures market participants choose to be much more cautious and still assigning a high probability that the Fed will stamp pat on the next FOMC meeting on the 25th of January, all right, which is still higher at 89.3%. So if you look at the aggregated one, that means combining other FOMC meeting down the road next year, market participants is only looking at one interest rate cut, perhaps the highest chance coming in either in May, June, or July. Okay, these three days, because of these are the three highest probability over here. And right now, there is actually not really a great chance, only about slightly high, 51%. There will be another cut at 10th of December to bring it down to 3.75%, but that's not high. That's about a 50% chance, like a coin tosser. So what I would say over here is that the market mechanism pricing based on the Fed Funds futures contract doesn't actually change that much, given that dramatic ex-post FOMC meeting outcome, which the Fed has indicated that they will not be so generous with their interest rate cut cycle in 2025. In fact, they will be on guard of potential inflationary pressure coming up from Trump's policy indirectly based on Powell's press conference. So for next year, still market is still looking at one potentially higher chance of only one interest rate cut. All right, so at the end of the day, market participants based on the Fed Funds futures contract are still not advocating a dovish Fed. But on the FX market and the stock market, they rallied. The stock market rallied because of technical factors, as well as the dollar strength setback also due to technical factors. When I covered the intermarket dynamics on the dollar index, you will be able to understand from a Elliott wave perspective, right from there. Okay, so so this is the key data, and as well as its impact on the broad-based cross asset classes that I want to share with you all that took share on last Friday. Okay, so now let us now jump into the intermarket dynamics. So I want to explain to you all, based on this intermarket dynamics on the dollar index that is impacting on the FX market, why there's a risk of a dollar strength setback in the near term right now. Okay, let's look at the dollar index. Okay, so the dollar index actually comprises of not all the dollar major against the other currency. That means it doesn't include dollar Sing, it doesn't have Aussie dollar, it doesn't have Kiwi dollar. It only comprises of majority the European currency, the Swiss, the Euro, the Sterling, the Canada dollar, and as well as yen. Then we have two Scandinavian, we call it uh, dollar. So more details are not touched about that, because but bear in mind the highest weightage inside the dollar index is the euro dollar, then thereafter followed by the yen and followed by the sterling. So now I want to share with you all that we know that from the low of September all the way it rallied upwards, right? So there's a steep push up. So this stage pull ups culminated on last Thursday. There's a big push up over here, which was the ex post FOMC meeting, where Fed Chair Powell portrayed a less dovish Fed in 2025. So I don't want to explain more about that. For those who want to find out more, you can look back at last Friday and last Thursday daily dose, which I posted on the OAP YouTube channel, OANDA Asia Pacific YouTube channel. So what I want to touch you over here is that the movement of this rally over here has already completed the fifth wave target, or a fifth wave Elliott wave movement on a multi-week perspective. So what do I mean by this? So if we look at the instant here, so I called it as, let me put it in black. So this will be the one, this will be the wave two, okay, and this will be the wave three, okay, this will be the four, okay, and this will be the five. Okay, so most important, we know that in a five-way structure, the wave three, the length of the wave three, that means from the low of 2 and 3 shouldn't be the shortest. So at least, right, shouldn't be the shortest among this one and wave 5. So how do we know that, right? If we were to do the Fibo extension of the wave 3, taking from the low of 1, push it up to here, okay, then push it up to the low of 2, you know it's one time. So the wave 3 is equivalent to the length of wave 1 by doing this extension. So that is really fulfill the 5-wave structure sequence. Okay, 1, 2, 3, 4, 5. All right, because in any 5-wave sequence, the wave 3 cannot be the shortest among the impulsive wave, which is the 1 and the 5. Okay, so now the next key thing over here is that at this high on last Friday, which is at the one around this 108.54 level, is this a potential 5th wave target that has already been formed, okay, on last Friday. So let's put it in this over here, okay, this level. Okay, so what do I mean by this level here? Oops. Okay, 108.54. Is this a fifth? Is this coincide with a 5th wave projection target, which is the 0.382, 0.674, 0.6718, 0.674, and 1 time? All right, taken from the low of 1, project it to the high of wave 3, and push it down to the low of wave 4. Okay, you realize that it hit the 0.382%. And let's look at the oscillator or the momentum indicator. So the momentum indicator also at the overbought level, and you realize that it starts to show a bearish divergence. Okay, there's a bearish divergence. This high lower than this high, lower than this high. All right, there's a bearish divergence at the overbought level. So what it means that this 5th wave target has the 5th wave target has the typical 5th wave target of 3.382 has coincided with last Friday swing high. RSI has really flashed a bearish divergence at the overbought level, and now it has really exit from the overbought level. So what it means that now there's a risk that this dollar index strength that takes shape from the low of September all the way up to the high of December. So that's about what, September, October, 3 months. Okay, 3 months of uptrend close to it may do a pullback. Okay, so this pullback may last for multi-week to multi-day because it's not pulling back from 4 to 5, right? It's pulling back from the entire 5-wave structure. So there will be a longer term duration of pullback that potentially may not last intraday. It may last multi-day to multi-week. All right. So given that the next pullback support level to watch out for will be the 20-day MA, and the most important one with the 50-day MA over here. Okay, so this one is very key. This level on the dollar index. So it's at 105.48. So what I mean over here is that given that there is a 1, 2, 3, 4, 5 push up, daily RSI is showing a bearish divergence. That means whatever dollar strength setback may not be just intraday, it could last for multi-day to multi-week, because now it's pulling back of the entire prior 3 months of uptrend, starting from the low of 30th of September. I would say 2 months, 2 months of uptrend from around 2.5 months of uptrend from 30th of September. That means the pullback of the entire 5-wave sequence rather than the pullback of wave 4 to wave 5 that could only last intraday. So if you do the Fibo retracement of this entire 5-wave up, okay, so what you see over here is that 23.6% and 38% coincide with these two key graphical support. Firstly, 106.73, which is the 20-day MA. 105.48 is more key because there's different element pointing to this 105.48. Firstly is the rising 20-day MA, and as well as this gray line here. So what this gray line is the medium-term former descending trend line, or I would say that this particular upper limit of this symmetrical range triangle from the high of 30th of October. So that's about a year ago plus back. So we have two different elements pointing to the same level at 105.48, making 105.48 as a much more higher significant support than 106.73, because there's only the 20-day MA and as well as some intermediate minor swing high, but this level here coincide with a former major range resistance now turns into a pullback support. All right. Okay, so what it means over here is that on a intraday basis, the dollar strength could start to creep back on the euro, the sterling, the dollar yen, and even the Aussie dollar, given that the dollar index now is shaping at risk of shaping a multi-day to multi-week setback story or setback narrative, or you call it the corrective pullback sequence. Okay. All right, so this is the intermarket dynamics on share we all more for today pertaining to the FX market. All right, so without further ado, now let us now jump straight into the intraday technical outlook on the broad-based cross asset classes, starting with the FX market first. So as usual, let me expand my screen so that you guys have a better visualization on the charts. Okay, so let us start with the euro dollar. Okay, so the euro dollar managed to actually bounce on last Friday, almost came close to our support level, because last Friday we were bearish with a support level, with the first support level to watch at 10330. So it printed a low of 10343, so give or take it's almost hit this level before bouncing upwards. So this bounce over here potentially is also in line with that dollar index shipping that pullback as well. So given that the intermarket dynamics for the dollar index is actually advocating for a dollar strength setback story, we will flip to a intraday bullish bias on the euro dollar using 10380 as my short-term pivotal support for today. So what's 10380? So if you look at the entire bounce up from last Friday low, last Friday session intraday low, that means European session low, is equivalent to the golden ratio of 61.8%, right over here. So as long as any potential pullback, because right now there could be a chance of a pullback as the RSI hit the overbought on Friday US closing session, and now it's trying to work out that overbought level. All right. So with that, let me highlight one potential minor support level that you guys could watch for today during the European session. Okay, will be at 1041. Okay, 1041. So 1041, as long as this pullback maximum shouldn't be below 10380. So as long as this pullback didn't have an hourly close below 10380, we will flip to a intraday bullish bias for the euro dollar. Intraday resistance level to watch, two of them for today. 10546, above it says 10516 / 10540, which is the correspond closely to the 20-day moving average, acting as a similar resistance zone as level as well to this graphical resistance zone. Only hourly close below 1.0380 will invalidate today's intraday bullish bias to totally damage that so-called corrective rebound sequence, or mean reversion rebound sequence on the euro dollar to see the impulsive down move resume. Next support level to watch, 1.0330 followed by 1.2900 on an intraday basis. So that's for the euro dollar. Turning our attention will be the sterling dollar over here. So the sterling dollar also never surpassed the first support level and bounce. All right, it's the bounce over here, and the way it bounced over here, very clearly there's a bullish divergence. All right, much more obvious, very obvious. Okay, over here, lower low, higher low. Okay, so with this bullish divergence coupled with that that intermarket dynamics that I share with you on the euro on the dollar index, pardon me, that potentially could shape that multi-day to multi-week dollar index corrective decline sequence narrative. We also be flipping to a bullish bias for today on the sterling dollar using 1.2525 as my short-term pivotal support level. So this one was this 1.2525. If you do the push-up all the way from Friday up to last Friday US session high, that's so the golden ratio of 61.8%. So with that, as long as any minor pullback didn't surpass with an hourly close below 1.2525 for today, we will flip to a intraday bullish bias for a mean reversion rebound scenario to unfold in the sterling dollar. First resistance level to watch, 1.2675. Above it sees 1.2720, which is the minor swing high of 18th of December at 18th of December. Only an hourly close below 1.2525 will invalidate today's intraday bullish bias to resume the impulsive down move sequence of the sterling dollar, revisiting 1.2460 / 1.2450. A breakdown below it sees the 1.24 figure level next. Okay, so that's for the sterling dollar. Now, turning our attention will be the Asia Pacific currency, starting with the dollar yen first. So dollar yen last Friday, we flipped to a bearish bias because of that bearish divergence, hitting the first support level before staging a bounce. Okay, a bounce off over here. So similar to that intermarket dynamics that I explained you on the dollar index, we'll still maintain that bearish bias on the dollar yen, but using a much tighter short-term pivotal resistance for today. So taking into account of yesterday's last Friday's sell off high all the way down to its low. The pivotal resistance level is close to the 0.618 and also close to this graphical level over here. Okay, previously minor swing low break, retested, can't manage to maintain the momentum and see that intraday sell off across since from the start of the European session all the way down to the closing of the US session. Right, so this level should be pretty much key psychologically on an intraday basis. 15735 will be my Titan short-term pivotal resistance for today, maintaining that intraday bearish bias on the dollar yen. A breakdown below 15585 exposes the next near-term support level at 15430 next. Only an hourly close above 1735 Titan short-term pivotal resistance will invalidate today's intraday bearish bias to see the bulls resuming its attack on the dollar yen, exposing the next near-term resistance at 15835/15880. Above it sees 15945 next. Okay, so 15945 is in fact this level here. Okay, this minor swing high in 15945. Yeah, this one, the minor swing high area of 12th of July. Okay, over here. All right, so now turning our attention now will be the Aussie dollar. So for on the Aussie dollar over here, okay, let me remove this. Why there is this level here? Okay, so on the Aussie dollar, what we could see is that the price action managed to continues to shape a bounce on last Friday, holding above the short-term pivotal support level at 62. So what we could see over here is that the daily, not the daily, the hourly RSI continues to shape a series of higher low. All right, higher low, and still hasn't reached the overbought level yet. So indicating that this mean reversion rebound may continues as well for today, potentially. You still no change. I don't want to put it so tight. So what I can do over here is I could offer a very short-term support level, okay, which is this level here. Okay, this is the low of last Friday, okay, before the start of the US session at 62.26. So as long as any minor pullback didn't surpass below 62 figure level, which is still the key short-term pivotal support, no change, we will still maintain that intraday bullish bias for that mean reversion rebound to play out on the Aussie dollar. First resistance level 62.85, 63 figure. Above it exposes 63.30. Okay, that's for the intraday basis. Only a push down and hourly close below 62 figure level, then we will resume the intraday, we call it a bearish impulsive down move sequence to expose the next near-term support level in first step at 61.60, followed by 61.20 on the Aussie dollar. So just a quick recap. On the longer term of the Aussie dollar, the longer term chart is actually bearish really. So what you could see over here is just a mean reversion rebound, hitting 62 figure level. This is the daily chart, potentially going back towards the 20-day MA and the upper limit of this medium-term descending channel from the high of September this year. Why long-term is bearish? Because very clearly it has a daily close below 63.60. So what is 63.60? 63.60 is in fact the close to the former major range support level of 30th October 2022, and previously the minor swing low, the medium term swing low of 10th of November, 19th of April, and 5th of August previously hit that level. It staged a multi-week rebound, but this time around it didn't manage to stage that multi-week rebound and in fact crashes below it. So what it means that the Aussie dollar has indeed properly shaped a bearish breakdown from this major range configuration that was previously in place close to 2 years ago. So that was 30th of October 2022. So what it means that what could unfold next, it will be a potential multi-week to multi-month corrective decline sequence. Yes, on the intraday basis, price action don't go all the way up or all the way down. They actually oscillate within the longer term major trend. And based on what I share with you all, the short term intraday technical factor on the intraday basis. So for today intraday, it will still manage in terms of probability to manage that, maintain that so-called minor mean reversion rebound scenario as long as the 62 figure short-term pivotal support holds. All right, so that's for the intraday technical outlook on the FX market. So now let us now jump our focus to the major stock indices, starting with the Hang Seng Index or the Hong Kong 33. So still no change, continue to be compressed within this sideways range, but still holding above our short-term pivotal resistance at 19,960. almost got the bearish reaction of it today in early Asia session. All right, at the start of the 9:30 a.m., which is the opening of the Hang Seng, the Hong Kong stock market. All right, no change, 19,960 short-term pivotal resistance. In order for the best to gain more impulses, it got to clearly break below this minor range support that has been in place since 17th of December, which is at 19,610. So a breakdown below 19,610 exposes the next near-term support level at 19,336. Only a push out and an hourly close above 19,960 invalidate today's intraday bearish bias to see another round of mean reversion rebound towards the next resistance at 2,300. Above it sees 20,300, pardon me. Above it sees 20,520 next. So that's for the Hong Kong 33. Now with that, let's shift our focus to the Japan 225 or the Nikkei 225. So the Nikkei 225 continues to oscillate over here. We're in a very sideways range. So yes, last Friday we were bearish. On the US session, it almost hit our first support level at 38,315. It printed a low of 38,384 before staging a rebound right over here. So what you could see over here is that potentially I will flip to a neutrality stance for today, so it could just go sideways again over here. So neutral. Okay, so I go to a neutrality stance. $38,315. Okay, so I'll flip to a neutrality stance. So neutral between 39,230 slash 39,480, and the lower limit will be 38,315. Okay, over here. So that's for the Japan 225, i.e. the Nikkei 225. Now, turning our attention will be the European stock index, the German DAX over here. So the German DAX last Friday we were bearish, hit our support level, the support zone at 19,690 slash 590. Okay, during the start before the start of the US session, before staging a bouncer, and upon that, you also start to shape that bullish divergence as well on the hourly RSI. So with this bullish divergence, right at the support level, that we have a bearish bias on last Friday, which met, and also at the rising 50-day moving average. So with this occurrence of this bullish divergence over here, potentially right now we could start to see a much more meaningful bounce going to play. So we will now flip to a intraday bullish bias on the German 30 using 19,690 slash 19,590 as my short-term pivotal support for this potential intraday bounce scenario to unfold. First resistance zone to watch will be at 20,000. Okay, first resistance got to surpass will be 19,960, followed by 20,105 slash 20,190, which is pretty key. Why? Because that corresponds to the former minor ascending channel support from the low of the 19th of November, now turns into a pullback resistance. Only a push down with an hourly close below 19,590, which that means breaking down below the 50-day moving average as well. That would invalidate today's intraday bullish bias to kickstart another round of what you call that corrective pullback scenario on the German 30 to expose the next near-term support level at 19,445, followed by 19,155 next. So that's for the German 30. Now, turning our attention will be the US Wall Street 30. So the US Wall Street managed to stage that steep bounce off from here. So previously we are looking for it to hit what 41,840. It did met and it shaped that bounce, right? And the way it shaped that bounce is also shaping that bullish divergence as well. As price action print a lower low, but the RSI is not showing a lower low. So with that, potentially right now we could start to see a kind of a much more pronounced intraday recovery potentially for today as well on the US Wall Street 30. So I'll be using a rather tight short-term pivotal support level for today. Previously, the minor swing high of Thursday and now turns into a pullback support. All right, 42,760 short-term pivotal support on the US Wall Street 30, flip to a intraday bullish bias. First resistance level to watch on the intraday basis, 43,325, followed by 43,720. However, a price action push down with an hourly close below 42,760 will invalidate today's intraday bullish bias to see the slide to retest 42,210, which was last Friday low. A breakdown below 42,210 sees the extension of this corrective decline to visit the major support zone of 41,840/41,590. Why this support is major? Because if you look at the daily time frame chart of the US Wall Street 30, this 41,840/41,590 confluence with the lower limit of this major ascending channel that has been in place since almost a year ago at 30th of October 2023. Okay, so that's for the US Wall Street 30, flipping to a intraday bullish bias using 42,760 as my short-term pivotal support. Now, what's next for the Nasdaq? So Nasdaq collapsed, all right, hit our first support upper limit zone. That was 21,780/21,630. So this was before the start of the US session, and also where it actually ended the 50-day moving average as well. So it staged a V-shaped recovery right at the 50-day moving average and right at our support. All right, so with that, the hourly RSI also shaped that bullish divergence. Okay, so given this confluence of positive elements, we will flip to a intraday bullish bias on the Nasdaq 100, no longer having that bearish conviction anymore, using 21,180 as my short-term pivotal support level. Okay, which is slightly below the 20-day moving average. Okay, so as long as any pullback for today that didn't surpass below 21,180, we will flip to a intraday bullish bias on the Nasdaq 100. First two resistance level to watch on the intraday basis, 21,600 followed by 21,890. Only a push down below 21,180 will invalidate today's intraday bullish bias to revisit 21,780/21,630, the 50-day moving average. Only a breakdown below it faces the risk of a multi-week corrective decline scenario unfolding to expose the next near-term support level at 20,335 in the first step. Okay, so that sum up the intraday technical outlook on the major stock indices. So now let us focus our attention now to the commodities market, starting with the gold XAU/USD. So for gold XAU/USD, last Friday we were bullish. Okay, he hit our first resistance level, 2,631 over here. So upon hitting that over here, the RSI starts to actually exit from the overbought level as well. So indicating that is actually a risk of a pullback, all right, taking shape. Okay, so what I'm going to do over here is that first resistance level to watch is at 2,631. I do not use this as my short-term pivotal resistance level. I use it slightly higher at 2,650. So 2,650 will be my short-term pivotal resistance level. Flip to a intraday bearish bias on gold XAU/USD. First support level to watch for today, okay, will be at this level here. Okay, let me put it in green and put it in writing. 2,606. Okay, so this will be my first support level to watch. A breakdown below it potentially could revisit 2,577. Okay, let me slash it up. Okay, 2,587, 2,577. 2,587. Okay, over here. Okay, so it seems to be still congestion inside this range. Okay, only a push up and an hourly close above 2,650 will invalidate today's intraday bearish bias to see a recovery scenario unfolding, exposing the next near-term resistance at 2,674. A breakout above it sees 2,728 coming into the near-term horizon next. Okay, 2,728 next. All right, so flipping to an intraday bearish bias, we in this kind of sideways range complex range configuration on the gold XAU/USD using 2,675 as my short-term pivotal resistance level. Okay, so lastly, the West Texas crude oil. So for West Texas crude oil, last Friday we flipped to a bearish bias using 1794 as my short-term pivotal resistance level. So the price action indeed went down, hit the first support before staging a bounce over here. Okay, so with that, still no change, still using the 70.94 as my short-term pivotal resistance level, still maintaining that intraday bearish bias on the West Texas crude oil. First support level to watch will be last Friday low at 68.80 or 68.81, 0.81 over here. Okay, a breakdown below 68.81 exposes the next near-term support zone at 67.85, followed by 67 figure level, which is the minor swing low of 18th of November and 6th of December. Only a push-up and hourly close above 70.94 will invalidate today's intraday bearish bias to see a minor recovery on an intraday basis, exposing 71.70 before the medium-term resistance of 73.15. So this 73.15 has preventing the boost from breaking up higher since 24th of October. So that's about close to about 2 months plus. Okay, so that's also sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar for today. What are the key data to look out for over here? So let me go to today's this week. Okay, in fact, this week will be a rather quiet week because of the holiday season as well. Okay, so for today, Monday, nothing interesting at all, unless for those who are interested on the Canada dollar, we do have Canada monthly GDP data releasing for the month of October, and as well as their PPI for November at 9:30 p.m. Singapore time. Then other than that, we have you have one more tier one economic data, which is the Conference Board Consumer Confidence data, out at 11 p.m. Singapore time today. All right, so that sum up today's daily dose of market insights. I'm Kelvin here, wishing you all a great holiday season, and we shall speak again tomorrow. Thank you.